Welcome, everybody. Let's see, audio check. Yep, looking good. Barry, Ernest, Jeffrey, Karen, Oscar, Rakit. Welcome. How's it going?
Good.
Let's see, we got a
Hey
chat.
guys, I'll get back to you in just a second.
Hey, Karen, how's it going?
That's fine, but I got two things going on. I'll be right back.
Okay, no worries.
Also, Rakesh is there.
Hey, Jeffrey.
How you doing?
Doing great. How are you doing?
Good, thank you.
Excellent. Ernest, how you doing?
I'm happy. How are you?
Excellent. Excellent. Barry, how are you doing?
Good. No complaints, man. How are you?
Doing great.
Away.
Doing
Nice
great.
weather. Nice weather.
Okay, cool. Well, I'll jump into a review of our current positions and what I'm expecting to happen, which is hard to expect much with the current U.S.-China trade war and the impeachment underway. But we'll look at kind of two outcomes and how we'll play it depending on what comes to fruition. All right, so I've done some pretty good upgrades to our daily update to make life easy for everybody. So I'm just going to review that outline and see if you guys have any questions on that. So we still have our normal summary up top, auditing the previous trade alert. And then what I've done is summarized the most recent trades for whichever trading asset we're on. So in this example, the SPY. Then below that, I have the asset allocation so that you have a constant reminder in case I make any changes, you'll see it right away. The only notable change currently is we went from 250 GDX to 200. And instead of just buying and holding it, hey, Oscar, we're actually trading it with the TLT on Thursday with the option caller. And that's because we've seen some pretty substantial volatility in the bond and metals market. So I think it'll just be a safer long-term bet to have that option to add a caller on our Thursday trade alert. Below that, what I'm doing for us is calculating the open profit loss. We got a race car driver flying by. Excuse the noise. The next thing we've done is.
I thought that was my wife heading to the mall.
Oh, right. That's hilarious. So the next thing I've added is the open profit loss on all of our positions. And that way you know what's going on. Especially this becomes useful when either if we're long and the position has gone above our call option we've sold, the profit loss can report a bigger profit than we really have. So I'm actually filling in the P&L daily with the open price so we can see real time how our portfolio is doing on every single position. So I think that's a good add-on. It does add about an extra hour of work for me each morning, but I don't mind it. And I think helps me keep better tabs on everything as well. So my new game is to see if I can memorize all 8 strikes each morning and keep up without having to look up the summary, which is right here. So we will have that for you. This is even more useful though when we're betting down on an asset because our P&L would show a loss. However, the options would be generating the profit. So this is now going to be updated daily for you guys. And so I'm just tracking the change of price and then the change of the option caller. Now do keep in mind that on the short call, time's on our side. So the time erosion will add to the profit. So the second we put those trades on, not a lot of the time premium has eroded. And I'll come back to emerging markets. This is definitely alarming and something we need to pay close attention to. In fact, this is what really makes me concerned that there won't be a trade deal. And we'll go back to that in a minute. TLT's a little odd today. We had the SPY near 310 and the TLT was popping up as well. And so it looks as though this massive TLT sell-off in the long end of the treasury may be coming to an end. So I'm very tempted tomorrow to no longer have the bearish option collar on the TLT and to flip it back upright. Because the big picture is the TLT is trapped. It has to go higher. Otherwise, we don't fund the US government. It's just that simple. In terms of trying to reduce a little volatility in the portfolio, that was the main reason for last week's trade. We had a 99th percentile sell-off the previous week on the TLT. So assuming that there'd be more downside momentum and that this phase one trade deal was really in the works, we did want to play it safe. So I don't regret that trade, and we haven't lost a whole lot on it, 23 cents as of closing it today. But I'm highly tempted to make our option collar on the SPY Friday, assuming the SPY keeps drifting higher. I'm tempted to get that option collar extremely tight on the SPY and then loosen our option collar on the TLT and GDX, expecting a little bit of a pullback in equities and a jump in the TLT and GDX. Now the catch is I'm probably going to pay some extra premium on the put on the TLT and the GDX and not be trying to get a big premium on the call. I want to catch upside surprise on TLT and GDX if the trade deal really breaks down. But on the same note, if the trade deal does occur, I don't want to be left holding the bag on another sell-off in the TLT. So that's kind of what I'm looking at. I'll have all night and morning to evaluate GDX and TLT. But that's kind of what I'm looking at right now. Now GDX, I'll double check my numbers. This was a very, very tight option collar, and it's supposed to generate a profit if the GDX goes down, but it's up 20 or almost 34 cents. So it's kind of curious that that's making money today. So I'll double check that tomorrow. But yeah, my calculation was we're up 9 cents on GDX, even though it's traveled higher and we have that inverted option collar. So I guess the time premium and change of volatility has delivered the profit on that so far. So that's some of the new additions to our reporting that should make everything a lot more simple on your end. Also, if you've noticed that my portfolio is not exactly at this ratio, I'm slowly rebalancing it this week. So today I added a couple hundred shares. I was short on the SPY. Emerging markets was accurate, but the TLT and I believe GDX may need to be balanced a little bit. So I was just off by a small fraction of this ratio right here. Moving down, I'm now showing you the return per month of the total return and the breakdown monthly per strategy, updated daily. Oh, no worries, Karen. All I had said so far is that we've greatly improved our reporting. So you have a daily update on the P&L of our open positions, and that I'm considering tightening the option collar on the SPY and emerging markets and going bullish on the TLT and GDX with the caveat that I might pay a little extra premium on the put without going for a juicy premium on the call. So we'll take a closer look at that in a minute. So now I'm updating this daily for you so you can see the P&L per month for the total strategy. We are down 0.4% in November. It's been some tough times. One day we have a trade deal, next day we have no trade deal. And so this really does have a big impact on how the market will move here. While we've been able to predict the SPY move, the bond market's been quite irrational, as well as the emerging market has gone off course. It's usually very correlated to the SPY with the assumption that we have a trade deal, but now we're going back to more of a period like the first half of 2018, where emerging markets were crashing and money was just flooding into the US as a safe haven investment. So we're up 1.3 on the SPY so far this month. Also, I've been updating our palette. This is mainly for further down the road, but you can see in the blue area that would represent the growth period. So if we were to have a massive stock market crash and what I call a reset, that's when these tickers might come into play in our portfolio. So nothing to worry about yet, but it just shows you how far down the road we're looking. in terms of planning out our strategy. The portfolio 2 gave up something like 1.8% return in November on emerging markets after delivering a nice 4% return in October. And this is very odd because usually emerging markets and the SPY should be traveling up together, but we've seen quite some selling in emerging markets, especially in the Chinese index specifically. It's acting weak. And also, we're not seeing China join the punch bowl in terms of increasing their money supply and debt and credit impulse. So that does lead me to question why is China continuing to drag their feet on this trade deal during a time where their GDP is crashing? And why aren't they expanding their credit to help support this crash in their GDP? So potentially, are they trying to create a recession as there's been no US president reelected during a recession on the election year? And so I think China does have the cards if they act quick enough to create a recession in the US. Now, so far, their slowdown has caused the opposite. It's caused massive money to flood into the US and depressed prices in global equities and near zero to negative rates on sovereign bonds in emerging markets. But if we go look back in time, anytime a major economic power slows down enough, it does drag everyone else with it. Perhaps the best example is probably looking at Germany after World War I. Everybody was trying to get all these reparations. Everybody had lost so much money. The US had lent the Europeans a ton of money, gotten all their gold, and weren't too nasty about getting repaid. But all the countries who had lost tens of millions of people and were in very rough times were very upset with Germany. And the story behind that's just fascinating. A lot of good books on it. When I studied that period, I looked at a lot of different viewpoints from soldiers to generals to presidents to central bankers. They all have a unique story. But the bottom line is Germany ended up going into hyperinflation because they were printing so much money to try to pay off their debts. And in doing so, it made the debts become more and more expensive as their currency lost value to the point that it sunk everyone. And we ended up with Hitler in World War II and a whole bunch of fun after that. So this is concerning to see emerging markets not correlating with the SPY. We should be showing a good profit with these emerging markets and the SPY at the same time. So to see that breakdown is definitely a concern. In the bond portfolio, the big picture is that the US government is creating more debt than it's creating growth. So we're in a scenario where our debt is growing faster than our GDP. And without the debt growth, we wouldn't have any GDP at all. So that's clearly a problem. And the only way we can keep these trillion-dollar deficits going is if the purchasers think one of two things. One, is the yield enough to beat inflation and potentially provide enough reward to not invest in stocks? And that's perhaps why the bond market continues to have plenty of demand right now. It's a positive yielding debt product where there's not a lot of options around the world. So from that perspective, it's still doing the job in terms of being able to sell the debt. But in order to hold on to that with inflation rising, the Fed really has to make investors believe not only are they going to get this yield, but that the bond price will appreciate. And so most people are now buying these bonds not for yield, but for appreciation, because they know in order to keep everyone holding their bonds, they have to slowly but surely keep these bond prices traveling higher and higher so that everyone doesn't run for the exit at the same time. And so we got a taste of what that could look like in the last 2 months. And you can see negative 1.4, negative 2.2. What caused that? Well, the big concern in the markets was this trade deal. Now, we're supposed to be signing that trade deal yesterday on the 12th. However, as you can see, today's the 13th. We have no clue what's happening with the trade deal whatsoever. So my inclination and hunch is that while Trump desperately wants to create a deal so he can have a cakewalk to walk into the next election, I don't think China's going to make it that easy for him. And so we'll see. I'll be paying close attention to Chinese media for any hints of that as the U.S. continues to tell us everything's fine. But the emerging markets would tell us otherwise. And once again, I have updated the palette for this for future use. These are some assets we might use to short the bond market. That's probably not going to happen until we get close to that zero bound on the interest rate, which could be perhaps 2 years off without a trade war escalation. If we get a trade war escalation, these market bubbles popping, the timeline can be shortened dramatically. And I'll review our two outcomes in a minute of how the two bubbles could potentially pop. Here's our precious metals portfolio. I do want to reiterate that our total return on this portfolio is 38.9%. The return calculated here is different. These portfolios have not added capital during the period. They've just managed the same capital. And so the year to date is relatively close. It's just a sum of the monthly returns. Whereas in this portfolio, we have been growing the position size dramatically because the circumstances have changed. In December, we had a Fed that was hiking rates and doing quantitative tightening for the past year and told us 2019 was on autopilot. That's not a market environment where you want to be long gold. At that point, though, we'd seen a 3-month stock crash and we're predicting that they would have to change policy. And so we started off with a tiny 2.5% position, which was mostly in Bitcoin and Ethereum. And as we saw confirmation that the Fed was becoming more dovish, it's become called the Powell pivot, we've gone to safer assets, primarily gold, and grown that portfolio. So we've had a relatively slow return in this aspect of the portfolio over the last 4 months. But if emerging markets are any hint as to what's coming up in the near future, if we can look at what the Fed's doing, gold has much further to go. And most likely, gold will only pop after the bond market has popped. So we'll probably be holding this position longer than any of the other assets above in terms of being constructive and bullish. Once again, I did update the spreadsheet and the palette. These would represent the blue, a growth period after a reset. So your gold and silver kind of is like the opposite of your platinum, palladium, base metals, lithium, and uranium. And again, I think we're several years out at the earliest before we'd be rotating into our growth reset mode. Okay, so that's a summary of how our trade alerts are organized now. A lot more information for you guys on a daily basis. And also, I want you to feel comfortable when we do have periods of drawdown that you know I'm well aware of it and you don't have to go, scratch your head and do all kinds of complex accounting to figure out what price you entered at and what our option caller is performing at. So now you can simply look at your daily update and have it all freshly updated on a daily basis. Now these assets are all very small spreads and extremely liquid. So our differences in returns will be relatively small. So you should have a very close return to what I'm displaying as long as you're following the ratios. So in terms of our current trade alert on the SPY, we've been doing this over and over again. We've been selling a call option $1 above and a put option we're purchasing $1 below. And as we get closer to the 315 to 330 range, I'm going to continue to tighten that option collar until eventually we'll actually want to invert it. And so I think we're at a pretty fair price with the assumption that there's a high probability of a phase 1 trade deal. But we can see the implied probability of this is becoming less and less by the day. So we can see that Trump is highly motivated to create a trade deal if he wants to get reelected, and if he also wants to distract everyone from the impeachment inquiry. From the Chinese side, they may not want a trade deal. They may prefer to put the pressure on Trump. So we'll just have to see exactly how this plays out. And as soon as it does play out, our job in terms of predicting the direction of each of these markets will get a lot easier. So this is definitely a tough period of time to deliver results just due to how uncertain the political climate is. So the new trade is at 310. We called for 315 SPY quite some time ago. I'm a little bit surprised how fast and furious it's risen up to this level and jumped ahead of emerging markets. So that's certainly concerning. And so we'll see what we play out tomorrow, but most likely I will flip the inverted option collar on the TLT and GDX to go back to bullish tomorrow, unless we have some fantastic news between now and then that the trade deal is making progress. And I'd actually prefer to see the Chinese saying that they think there's a trade deal rather than Trump. Okay, so that is a review of the organization of the trade alert. Any questions on that before I jump into kind of the two outcomes I see happening? Okay. All right, let's see. So I'm going to pull up. This is part of our boot camp program. We're just going to go through a few slides.
I got a question.
Sure.
If you've got new money to deploy, you could make all these trades starting like tomorrow? Or is there a certain time to start? I moved some money from one account to the other, you know, and I finally got everything in the right brokerage where I can make these trades. But right now, I'm just in money market right now that I moved all my assets to one brokerage.
Yeah, I had this exact question on our boot camp. Great question. I'll answer it right away. Okay, so that's a good question. You know, we know we're in a gigantic bubble, and we know it's a very highly risky environment. We've got impeachment inquiry. We've got the risk of someone like Elizabeth Warren becoming president. We've got debt growing at a faster rate than GDP. We have a Federal Reserve that is misreporting inflation. So we know we're really at the whim of the Fed to say, all right, we got to raise rates. So certainly that's a great question. And it does involve a smart strategy for how to enter the market. So here's what I said yesterday. So number one, don't buy any of these assets except for on the trading day. That way you can immediately apply the option collar. So the option collar is our first and most important layer of defense because it gives us an absolute maximum risk on the put option. And that's really the most important part is we have to have a maximum cutoff on what we could potentially lose. The ratio of the SPY and the TLT helps us generate profits in all these crazy market environments, but it's really your put option that makes our strategy so safe. So in terms of when to enter the market, I would try to time the SPY ETF not on a Monday, but rather on a Wednesday or a Friday. And I would only do it on a Friday if I first was doing the TLT and GDX on a Thursday. So if you wanted to add some position size to your SPY today, you could do that. Put the collar on it and then jump into the TLT on Thursday and then wait until Tuesday to join emerging markets. Now, alternatively, if you wanted to wait a day, you could join the TLT and GDX on Thursday and then add in the SPY on Friday and then the emerging markets on Tuesday. What I wouldn't do is do the SPY on Monday and then wait all the way till Thursday to do the TLT, just because now you have 3 days of no protection from the bond market to protect your equities portfolio. So that's a great question. Does that make sense?
Yeah, that's great.
And another question is, a lot of people ask me, should I add to my SPY position? I say no, not unless you're going to equally add to the rest of the portfolio. Now, the only thing I'd say is really optional if you wanted to really simplify this portfolio, and especially at this point in time where we're not clear we have a trade deal. If you did want to leave out any aspects of the portfolio, you would leave out the 200 shares of emerging markets and the 200 shares of GDX. So that would not affect our general allocation and correlation of assets at all. You're going to lose a little bit of the inflation hedge on GDX, and you're going to lose a little of the potential alpha or extra profit you can generate on equities from emerging markets. But you're going to have the exact same essential ratio of stocks to bonds. So if you want to follow the full program, best bet is do the SPY on a Wednesday, jump into the TLT and GDX on a Thursday, and then do emerging markets on a Tuesday. Now we do have some people just doing emerging markets and TLT. And so if that was the case, it wouldn't matter. I would probably do emerging markets on a Tuesday and then jump into the TLT on a Thursday if you're just doing those two trades.
That's great, man. I appreciate it. That's great information.
Sure. And so, we're huffing and puffing over worrying about losing 0.5%. But yeah.
Hey, Jason. Jason, this is Rakesh here.
Hi, Rakesh. How's it going?
Good. I do have an imbalance in my portfolio because I have more TLT as a ratio of the other assets, right?
Yep.
But I'm not selling them now because the TLT is down so much. Is that the right thing to do?
No, you should keep the ratio of capital at all times. So we changed.
Yeah, but that would mean that I will have to take a big loss in TLT.
A lot of people have that. They're like, oh, I don't want to realize the loss. It's just not smart. The whole strategy is, we changed that way back when Trump and the Chinese came out. Here's what happened. Before the meeting, we had Vice Pence go on national TV and bash the living daylights out of China. This was when they're supposed to have these trade talks back in the start of October. We had Vice Pence bashing China on public TV with the speech that had been delayed for a month. We had sanctions going up on 17 companies. We had Trump at the, World Nations, in front of the entire world, go up there and publicly bash China. All we had that looked progressive in terms of progress was some agricultural purchases from China. So I had you overweight in the bond portfolio leading into that moment because I was expecting the trade deal to do what it had done for the past 2 years, break down. But lo and behold, what did we have? We had phase one trade deal come out that Friday. So by that Monday, we told you to get rid of your put option on FXI, and we told you to reallocate capital to be heavy in equities because a phase one trade deal is very bullish for equities and bearish for bonds. So that's why you can see we're overweight in equities and slightly underweight in the bonds. Now, are we about to have a mega shift back into the TLT? Maybe. And maybe you could make some extra money guessing that. But maybe we get a phase one trade deal and TLT crashes even harder. So, my recommendation to you is I'm going to balance the portfolio on the best information we have at that moment in time. And so we go back to the very start of October. There was really no good information for me to tell you with confidence that we're going to make a trade deal. We had China doing what the U.S. said they wanted, buying some farming good products, but we had public speeches given out to the entire world that were bashing China. We had sanctions hitting different companies. So I had no reason to believe that a trade deal phase one would be the outcome of that meeting. So we were positioned for the worst outcome at that period of time. And that's why we've had some slow returns, because we didn't get that. We got the phase one deal, and that made the equities market fly up. So So yeah, it's up to you, obviously, but I would not try to guess the markets that much. The way our strategy works is we have essentially a strategy that we can be wrong or be caught off guard and generate substantial profits. And that's happened many times. In May and in August, I did not expect an equity sell-off. But because our put option kicked in, and here, watch, let's just look at that. Okay, if we go to May, I really didn't see that coming from a mile away. But what happened? The put option on the SPY kicked in and the TLT shot up in value. So that's how we got a nice profit in that sudden sell-off. If we go to the next month, I was expecting the trade war to escalate in July, and I was wrong. We lost 1% because of our strategy, because we still had that long equity position. The sell-off in the TLT didn't hurt us that bad. And then what happened? And then by August, I thought, all right, Trump's just going to kick the can down the road and try to win the next election. Well, surprise, he got upset and raised tariffs in October and in December. So luckily, our TLT saved the day there. So this has been a very difficult time because Trump changes his mind every other month. And so, if you want to hold your TLT position, then you better be betting on the trade war escalating in the near future and not actually, it's either got to escalate or just not happen for that TLT to probably generate a nice profit and give you a bounce in the next few weeks. And sure, I'm starting to think that may happen. So it's up to you. But if it doesn't, just realize there's a lot of downside risk in the short term on the TLT.
Okay.
Does that make sense? Fair enough?
Yep.
Okay, so let's look at some potential outcomes of how the market plays out here.
Before you leave that, can I ask a further question on that same subject?
Please.
I'm perfectly balanced between the TLT and the emerging markets and the SPY, but I haven't been able to bring myself to jump into the GDX because every time I look at it, it's still going down. And so my question to you is, gaze into your crystal ball and tell me, is GDX going to keep going down, or have we bottomed out and it's okay to jump in now?
Okay, so the big picture, there's two stories. If you believe that the global slowdown is bottomed out, that all these PMIs are going to pick up, that China's growth is going to stabilize at 6%, and that the Fed's not going to drop rates anymore, and that this QE is going to slowly slow down. If that's the case, then you absolutely don't want to hold GDX. Okay, but if you believe the opposite's true, if you believe China's growth is slowing at a rapid rate, if you believe that there may not be a China trade war, if you believe the US government is going to create large deficits, in fact, if you believe the US government is going to create debt at a level that's faster than its growth, which is the case right now, then their only solution is to lower interest rates and to monetize government debt. And so right now, in the last 6 months, the Fed has dropped interest rates 3 times, and they've printed $280 billion. So if they're going to keep this trend going, then most certainly we don't want to miss out on the run-up in gold and silver. And so all you really need to do is go back to 2009. That's when they, let me pull up some charts here. Okay, so the main periods of time you want to own gold is when there's a lot of increase in money supply. And so, sorry, I was just looking at Oscar's doing. It says gold and GDX are doing nothing but consolidating after an aggressive run up, which is a must for further move higher. Yeah, so the big picture is that all these governments are creating debt at a rate faster than they're collecting taxes. And so to service those debts and the interest that those bear, they're lowering interest rates and buying up their government's debt. So that's the big picture. And so unless you see massive fiscal change in the big governments, the US is probably the most important, this trend is going to be very hard to stop. They either have to allow the yield to spike, in which case the interest payments will skyrocket, which nobody wants. Right now we have $500 billion a year of interest payments. So anyway, long story short, quite clearly there's 27 central banks that are scheduled to lower interest rates in the next 60 days. The only one we're not really seeing get aggressive with monetary policy right now is China, which is alarming because their growth is the one that's been slowing down so rapidly. But yeah, I would say, especially now that we have the option collar, gold will add a lot of value to your portfolio. The only thing that would potentially be dangerous for gold would be, number one, we stop creating so much government debt, that's not going to happen in the next 12 months. So we don't have to worry about that. The next thing we need to worry about is the Fed going to raise interest rates. Well, they've told us they're absolutely not going to do that anytime soon. Okay. Next thing we need to worry about is, are they going to start selling government debt? And I'll just pull up the chart we had today so you can see what they're doing. And we've been playing gold for most of the year, expecting that this would begin to occur. Oh, I put it in the top of the US. All right, so we went from $3.7 trillion on the start of September. And now we're at 4.03 trillion. So what's that? That is about $280 billion of debt that's been monetized. So that is a huge, huge increase in their balance sheet. So if that continues, which it's on track to continue at a rate of $60 billion a month, we definitely want to be long gold. Just bottom line, that's what I will say on that. Now, do I expect some short-term volatility in gold if we get a phase one trade deal? For sure, definitely. If we get a phase one trade deal that involves rolling back a bunch of tariffs, that will probably be very bearish on TLT and GDX. And if so, we'll use the inverted option collar, and we can make a lot of money if gold goes down by having the inverted option collar. So because we have moved this from just a simple buy and hold to trading it with the option collar, we can actually generate profit if we get the prediction correct in either direction. And we actually make a lot more money betting down because assets usually fall much faster going down than they go up. Does that answer your question, Ernest?
Yeah, thank you.
So yeah, certainly the big picture right now is that everybody's having fun printing money and lowering interest rates. And that's after they tried to raise the rates in 2018, and we had 98% of all assets in the year at a loss. Only thing that went up was the VIX. So unless something substantial, we really need a lot of things happen. We need the government to spend less than its growth, one. Two, we need China growth slowdown to bottom out and at least flatline. 6%, 5% growth is fine. What's more concerning is the change of growth. So the change of growth went from 14 to 6. So when you look at it, from a 5-year viewpoint, why do you think its growth is going to stop slowing down? And perhaps without the pressure from the United States, maybe, just maybe, it might slow down or stop slowing down at such a aggressive speed. But right now, there's really no reason I can find to think that A, China's growth is going to slow down, or that the US government's going to stop creating deficits. Now, Michael Bloomberg, if you listen to him, he wants to balance the budget. He's a penny pincher, and he might be the kind of, they ask him what's his position on policy changes, if it's something that people don't like. And he has this analogy where, well, if you got a Band-Aid on a wound, I just like to rip the whole Band-Aid off and get it over with. So, if he came in there and depending on what his policies were, he might try to balance the budget. That would be a nightmare for the equities market and for gold. But yeah, for the next 12 months, I don't see it. I see China potentially trying to aggravate Trump. I see impeachment inquiry creating fear. I see a massive deficit that's going to apply pressure to the bond market and force the Fed to keep up the quantitative easing. So yeah, I like to be long gold right now. But I will say I have moved it to the option call or trade on Thursday. So I'll be more than happy to short it if we get a phase 1 trade deal. And that would be for a short period of time. Even with a phase 1 trade deal, that doesn't change the big picture of where the bond market's at. It just provides a little short-term volatility and a lot of hope that maybe things can get better, but it's not going to change the primary problem we're dealing with, which is just increasing interest on a massive amount of debt that's really dragging on our growth. Any other questions before I look at 2 potential outcomes of how these bubbles pop? Okay, well, let's move on. So we're in the 11th year. The Fed loves to talk about, let me see if I have a chat. Oh, I got someone raising their hand. Oh, here we go. Thomas, how's it going, buddy? I got you unmuted, sorry. And Ron, you're unmuted now.
Now I'm unmuted.
There he is, how's it going?
Going well. I wanted you to comment. Several times you have, I would say, my impression is a negative comment about Elizabeth Warren. And I would like you to comment on the statement of the wife of the husband and wife team of the 2019 Nobel laureates in economics in an interview last night on TV, stating that there is no evidence that the rich, the super rich, will slow down on trying to make money no matter how much they're taxed.
Well, let's look at this. This is a compounding calculator.
And I have no axe to grind.
Oh, fair question, sure. All right, let's see. So I have $100,000 and I can grow it at 2%. So she wants to do, 2 cents is what her famous thing is. Anybody got a guess how long it takes to double your money at 2% a year? What do you think? 35 maybe? 40?
What is it? The rule of 72 or something?
Okay.
36.
36. Okay, so if I take 2% of your wealth a year, and I'll go into, there's a lot of problems with this, but if I take 2% of your wealth a year in 35 years, you are at 0. And that's not really true.
Wait a minute. That's there's zero on the first $50 million. So you're never going to go to zero.
Right. So yeah, but you get the picture, right? That's what the billionaires don't like. So let's think about how this would really go. So let's say I'm Jeff Bezos. Now, my net worth is what, $140 billion, but it's not in cash. There's not many billionaires who have much cash. They primarily own equity. And so their valuation of their wealth is highly dependent on premium, multiple earnings on the company they built. And so how are we going to take 2% of their wealth away? Are we going to just take 2% of his stocks? That's going to be hard to distribute. Are we going to start distributing stocks to all the people we pull this money away from? No, we're probably going to sell it. So imagine the pressure on the equity market if we start forcing all the billionaires to liquidate 2%, just 2% of their wealth a year. What do you think that's going to do to the stock market? That would be now old Jeff Bezos, just him alone is going to have to sell $2 billion worth of Amazon stock per year. And so yeah, that's one problem. Just with the 2-cent tax, you're gonna scare the shit out of all the billionaires. And more importantly, how do you even do that? They're gonna have to start selling assets every year. So you're gonna depress all assets in the United States. So just that one policy alone, I would be, well, who knows? Now we got Hillary Clinton and Michael Bloomberg stepping in now that they see Joe Biden struggling. So she runs a smart political angle in terms of recruiting all the youth. She wants to get rid of all of the student debt. I think that's several $1 trillion. Okay. So buy that up, put it in the Fed's balance sheet, no problem. So expect college prices to skyrocket. They already have gone up massively because of the guarantee. You can't bankrupt a student loan. So immediately, anytime the government has come into an industry, let's just look at that. That's an interesting slide. Here's what happens when you try to use state-managed economics. And you can just see it with the inflation in these different asset classes. Okay, so red line is medical cost. Let me find the college one. Oh, okay, there you go. All right, so I can't remember the exact year, but at one point, the government, in a good intention, they want to help spur education, get more people into college, get the banks to allow more people to take on the debt to go to college. And where are we at now? We got a ton of kids with expensive degrees, and they're working waiter jobs. And what's happened to the cost of college tuition in the last two decades? It's increased by 170%. Peter Schiff has a great piece all about just this. And several decades before the government was subsidizing education in the college realm, I think an average cost to go to an Ivy League school was something like 3 months of work. So 3 months of work, you could pay for a basic degree. That's not the case now. Now you're going to go rack up almost a lifetime's worth of earnings to get a degree. So that's the concern. That's what everyone's going to be concerned about if Elizabeth Warren comes in, because she wants to subsidize even more so than we are college education, medical costs, primarily those two. And look at the increase in housing. That's another industry where we went and bailed out all the banks for putting out bad loans in 2008. And so you can see whatever the government puts their hands on, the inflation rate is massively ahead of everything else. And why? College shouldn't cost 170% more now than it used to. or just, you know, what's happening with productivity and education. It's gone down 170%. That doesn't make sense. So yeah, so I mean, those are the two big things. If you tax them at 2% a year, they're all going to have to start selling assets. There's your stock crash just with that. And then as far as the bond market's going to be concerned about inflation, well, yeah, it's going to be much more concerned about inflation. So you're going to crash your growth. You're going to scare out all the billionaires. You're going to force them to sell assets. And
Yeah,
you're
well,
gonna,
okay, that is valid if they remain static. But if they keep on making money, then they might make enough to pay the 2%
Exactly.
out of current income. Now that's a wild guess, yes. But anyway, I just want to stir the pot a little bit.
Sure. Yeah. You know, it sounds great until you actually think about it. But yeah, well, you know, if she is leading, if she becomes the Democratic nominee, I will spend a hell of a lot of time evaluating her policies, whether she could actually push them through. You know, it's not that easy to push some of her ideas through. A lot of them are actually unconstitutional. So my bet is she won't, you know, I don't think Joe Biden or Elizabeth Warren are going to be the nominee. The problem for Elizabeth is that she has no backing with anyone who's rich, because all of her policies destroy that. Same problem Bernie has. You know, they get stabbed in the back before they get close. Even though they're so good at raising money, they have this message that the masses are appealed to. She's busy on Twitter. Her ratings go up every day, but she doesn't have the powerful elite backing her. So that's going to be difficult, potentially, probably the Achilles heel for Elizabeth Warren. Meanwhile, Michael Bloomberg, this guy has given more money to philanthropic causes than Trump is worth ×5. Now, we don't really know what Trump's worth, but one of the Forbes estimates is $2 billion. Who knows what it really is? But think about that. Michael Bloomberg's given away $9 billion. His company is not publicly traded, and his net worth's at $50 billion. He was a mayor for three terms in New York, and each time he spent something like 10 times as much money as his opponent to become the mayor. So I think he was spending like $250 million back then. So how much money would he put up to go into this election race? It's going to be exciting one way or another. And so, yeah, all right, let's go back to.
Wait, would you make one more quick comment on what you were talking about, all of these educated people who don't have any jobs? How about Andrew Yang and everybody has a basic income?
Yeah.
$100 a month or something.
Sure, yeah. So, you know, are you asking if I personally like the idea or how I think that would affect the markets?
Both.
Okay. Well, you know, it's not the worst idea in the world from my point of view. Jeffrey Gundlach has a funny comment. I really look up to Jeffrey Gundlach as a mentor and someone I pay close attention to. Now, he was extremely accurate predicting 2018, 2017. Extremely inaccurate this year. So it just goes to show, even the bond king, you know, he's a multi-billionaire. Great story. Guy, one of the best of all time for sure. So even the best of all time can have bad stretches. Ray Dalio's down a little bit this year in one of his funds. He's rarely lost money. But yeah, Jeffrey Gundlach said, well, you know, if $1,000 a month is such a great idea and will solve all our problems, why stop there? I think that starts off at like $6 trillion a year. You know, why not give them $2,000 a month or $4,000 a month? Hell, let's give everybody $20,000 a month and now we'll all be rich. So that was, you know, that's like the first thing. But yeah, so, you know, what happens when here's what mankind seems to have a very difficult time figuring out is, you know, we know we're becoming more and more productive. We're creating all these technologies. Some of these technologies are hard to measure. Stanley Druckenmiller is pointing out, we have a hard time calculating the growth of things like images or text messages or tweets or digital media, things of that nature. So we've got this situation where we know the world's growing. We have population growing at an exponential rate. No other animal has grown at this speed. And the only reason we can continue to sustain it is because technology is improving at even a faster pace. So if you don't increase the money supply, you end up, with everybody thinking the value of their dollar is going to go up over time. So why would I make any purchases right now? I might as well wait till next week or next year. I'll be able to buy twice as much shit. So that's why the Fed has this mandate to create this inflation and to slowly but surely, they like to call it organic growth of the money supply. And so, so that's their problem, is trying to figure out just how much the world is really growing and to increase the money supply at the right speed and to control the cost of money. And so, that's this interesting job of the central bank. But right now, the way it works is they loan that money out to the banks, and then the banks get to determine who's creditworthy and supposedly, responsibly loan out the money. And so if that were the case, maybe that system would make a lot more sense. We don't need to just go give out the money randomly to people. We want to give it out to people who will be productive. But what really happens is the banks take that money, and then they're really not concerned about anything except trying to generate a profit and also take advantage of the government. And the way the banks take advantage of the government is they actually created the Federal Reserve. It's nothing federal about the reserve at all. And so they get bailed out all the time for making bad investments when they should be punished. And so we end up in a world where all the money that's being created is just being circulated to the top 1%, to the people who own the stocks. So all the money is going right to the corporate bond market, and then that's just going to buying back its own stocks. And so none of the money is flowing anywhere. Very, very little of it is flowing into the masses. So this whole idea of giving everybody $1,000 a month and letting the money find its way to where whoever earns it fairly, that might not be the worst idea in the world. Now, the big question is, will it make people more productive? And that's, if they give you just enough to maybe give you a little nudge, maybe there's a case that that's a smart strategy. You give them too much, guaranteed everybody's going to be super lazy. Maybe it should only be a bonus if you have so much income. If you make $2,000 a month because you're being a productive member of society, you get a bonus $1,000 a month. So that's how I'd argue it from either direction in terms of the Yang effect, the Yang gang. Any questions or comments on that?
No, I have no, I'm confused by it. And
Well,
in
it's
California,
just,
I live
they
in
loan
Oakland,
money to the
California.
banks. They want to give it away for free to the people and then let the companies out there collect it back up. So instead of top down, bottom up. That would surely create some inflation if the Fed really wants some inflation. Now, what's funny is in the last speech by Jerome Powell, he talked about how they're designing some new system to force inflation and to get rid of all the money just sitting in these asset markets. So he said that's due in the middle of next year. Nobody knows what. I haven't even seen people comment on that little piece, but yeah, that's that's where that whole plays out. Now, of course, we're already handing out money through the government and paying for it by monetizing the debt. So we're already doing that to a degree for a whole lot of people. This would just accelerate that concept.
I live in Oakland, California, and we have thousands of people in tent cities living underneath the overhead freeway spaces. And it's a growing problem in California anyway. And I just wondered if that might be a partial solution to that issue. But I'll sign off now. I've taken too much time.
Well, it's a good question. You think a homeless guy on the street, if he had $1,000, will become a productive member of society, or is he going to go get some booze and drugs and party? That's really the question on the homeless situation. I think if they did that, there should be a qualification. You got to get your ass a job and have some income and be paying taxes, and then you get a bonus. I don't think they should just give it out to people who are not productive. But that's a much bigger problem. So good questions, topical questions. I love it. Thank you for asking, and don't be shy to ask more. I'm sure everybody found some interest in that. Okay, so let's look at how we pop these bubbles and how long it may take to happen. Okay, so this is my rosy prediction. No China trade war. We get the phase 1 deal. And the impeachment turns out to be something like the Mueller report, okay? Nothing that really freaks people out and creates a panic. And this would also mean that we don't have something uncovered from the repo market where we're loaning out between the 14-day and the overnight. Something like $180 billion is a revolving line of credit right now that's keeping the banking system operating. So we don't know what that is. Only thing we really know about the repo market is who are the primary dealers. They're the ones who have access to that. So there's some 50 banks that have access to that. Beyond that, we have no clue because those banks now are partnered with thousands, probably tens of thousands of banks. So is it SoftBank? Is it WeWork, which is part of SoftBank? Who knows what is causing this dramatic $180 billion that needs to be lent every night. So that's not uncovered. That could create a panic. Trump gets impeached, it goes to the Senate. We start seeing some Republicans not show support. That could create a panic. China just continues to drag their feet and not make any changes. Trump raises tariffs. That could cause a panic. So right now we don't have the panic. We're at all-time highs, but I just want everybody to realize how risky these markets are because of those are the three big things that really concern me. The fourth one is that China doesn't seem concerned with their de-acceleration. So 6% GDP is great. What's not is a 100% negative acceleration in GDP. So it's actually lost 100% in the last 5 years. So that's a very fast decline. So those four elements are very alarming. Let's just say everything's fine. China's going to bottom out. They're going to be reasonable, make a decent trade deal. They really want to not decouple with America. They want to figure out how to, make us happy with the 7 sins as Peter Navarro lays out, and the impeachment blows over. All right, what happens? So we have a period of low interest rates. We have low inflation. We have quantitative easing. These are the ideal ingredients for a market bubble. This is a bubble where just about everything goes up except for volatility products. And so we've seen it. We've seen the SPY and TLT travel higher this year. We've seen emerging markets travel higher this year, and we've seen gold prices go up remarkably this year. And so this is the general strategy we want to have during this environment. Now, that doesn't mean we can't say, okay, the TLT is overbought, the SPY is oversold, and be playing with our option callers a little bit, tightening them, loosening them. But the big picture for most of this period of time, we want to be pointed up in our assets. So this is where we're at right now. But what happens if this continues for too long? Well, we end up with inflation is the most likely outcome. And now I can show you a bunch of charts that we already have inflation, but we just saw it uptick today, a point or 10 basis points, so 0.10. You do this long enough, you print enough money, you lower rates to zero. Sure enough, you're going to get inflation. And that's going to cause the Fed to say, all right, we're going to have to start thinking about if this inflation continues to run hot, warning to everybody, we might have to start raising rates. So they haven't started doing that yet. But the second that the bond market thinks the Fed is feeling safe, feeling like they have enough room for raising interest rates, either because there's inflation or because the economy is looking so strong, like they did in 2018, your bond market is going to freak out and sell off. Okay, so in this situation, SPY keeps going up, gold keeps going up, silver keeps going up, but it's at the end of the rope. Because what happens next is the bond yield gets so attractive. Now, I want you to think about October of 2018. The 10-year hit 3% yield. That is absolutely too irresistible for the banks. They will go take all the money they have and use as much leverage as they possibly can to get a guaranteed profit. Because the only way they lose on a 3% yield on a 10-year treasury is if inflation goes above 3%. And the Fed doesn't even want it to go above 3%. They want it to be around 2%. So anytime the yield gets too attractive, that creates a huge shift of money out of the stock market into the bond market. So around this period of time is when we're going to want to most likely get out of our SPY, silver, gold, and you get this kind of back and forth move. We got the stock and bond market pulling one another back and forth. But if we've done this in a period where we have no more room to lower interest rates, you find yourself in a position where now the Fed has no option but to raise interest rates because of rising inflation. Now, that's when you need to be short just about everything. So leading into that period will be when we need to get out of stocks, out of gold, and start betting down on all of these assets because the Fed's going to have to raise interest rates. And I'll bring us up a 100-year chart of the federal funds rate so you can see the different major market cycles we've been in and why this time's nothing like the dot-com or the 08 or the 90s. And that's because the federal funds rate was significantly higher and there was room to continue to drop these interest rates. Right now, we're almost at zero. So eventually, rising inflation and rising interest rates will make our strategy of being long the stock and bond market come to an end. And the problem with that is the entire financial system is engineered to be exactly that, long stocks and long bonds so that they can generate safe returns like we're doing. The same strategy we're doing is what most professional top-notch hedge fund managers do. Okay, so that's one outcome. Probably, what's the chances that we don't have China slowing down below 6%, that we don't have the impeachment freaking people out, and that we get a trade deal? I'd say it's less than 50% odds. So I'm not really in the camp, and you've seen with our trade alerts that I've been ready to bet that the China trade war is going to escalate at every opportunity. So far, it hasn't yet, but we're running out of time. The next election is coming up, and China really has a chance to really put the pressure on Trump. So I would put the odds on this below 50%. But until that narrative really changes, I'm not going to be betting down on the SPY because credit's so cheap. The banks can just borrow for free. The corporations can borrow for free. And they can buy the stocks. Okay, so what happens if there's panic? What happens if China escalates, impeachment becomes a real fear, and tariffs go up? Well, we're going to see interest rates quickly zoom to zero. We're probably going to see a short-term sell-off in stocks. We're still in a period of low inflation. We have quantitative easing. So this would want me to position our portfolio for potentially a short-term sell-off, talking maybe 3 months at most in the stock market and emerging markets. Okay, that's going to force the Fed to use the rest of their ammo, lower interest rates, massively increase QE. This would be the best outcome for our bond and gold portfolio in the next few months. So we'd want to do the inverted option collar on the SPY and emerging markets, and then do the bullish loose option collar on the TLT and GDX. What happens when we print too much money? Well, now we're gonna expedite how fast the Fed prints money and pushes us to the end of the rope, the 0% federal fund rate. So that creates inflation. Now the market knows there's no more room to cut rates. So only thing the Fed can do now is just buy up everybody's bonds and try to control a disaster where the whole world realizes they have bonds that are going to yield nothing, less than inflation, and they're all rushing to the exit to sell their bonds. And we're talking $21 trillion of bonds out there that could be running for the exit just in America, and 188 trillion in sovereign debt worldwide that are all in the exact same circumstance. So it's a scary picture when you realize where we're at. And I'll show you the chart where you can visually see what Ray Dalio has been talking about, preparing everyone for. This is not your normal 10-year business cycle that you can have a little crash and everything's going to be hunky-dory and bounce right back. And then you end up with a period where now the Fed has no choice. They have to raise interest rates to pull all the misallocation of capital out of the economy and to fight off rising prices. And so we end up back at the same scenario where we're short stocks and short bonds. And now all of a sudden, just having some money in the bank is the best strategy there is, because they're paying you very high rates of interest. And then after that, you finally have your reset. And that's where I roll out a Warren Buffett style strategy where we're going to take on a lot more risk. So in the beginning of the portfolio or the presentation today, we were looking at all those little blue sections. That's representing what potentially might happen. And we're looking pretty far down the road. You know, this right now is estimating 9 years. Now I'll talk about what potentially could make this last a little longer. Let me pull up this chart so you guys can see what's coming at us. Okay, so the blue line is inflation, the red line is the federal funds rate. And so at first you might think it just looks like a mountain, but once you really understand what's going on, it's a much scarier situation. So we really haven't been in an 11-year bull market. Really, we've been in a 40-year bull market. And the only reason we've been able to be in such a long expansion is because we came from a period of extremely high interest rates, which actually were as high as 22%. And we've been able to cut interest rates. That's the cost of money, has been able to, the rate of change of cost of money has been able to be very aggressively dropped over the last 40 years. Now, they drop it and raise it back up, and then drop it and raise it back up. Every single time they try to raise it back up, you can see the gray line is a recession. Okay, so they've done the same trick for the last 40 years, but now they can't do it anymore because we're at zero. So the only option they have at this point is either to go to negative rates, which I don't think they will do, or to start to raise interest rates back up and go through a period of a recession or even a depression. And so what I want you to pay attention to is not only was the Fed able to, let me try to get that to pop down. Not only was the Fed able to predict stock market crashes in almost every single instance, you can see that because before the recession hit, every single time, what are they doing? They're dropping rates as fast as they can. And they're doing it by a change of rate by about 5 to 6%. So this recession in the 90s, they dropped it from 10 to 3%, a change of cost of money of 8%. That's a huge, huge credit impulse. They're able to jack the rate back up towards 7 by the time the dot-com bubble came around. And then we got a crash. Before the crash happened, guess what they're doing? Dropping rates. They had to drop those rates from 7 to 2 to get out of that recession. And then as soon as they thought the coast was clear, they pushed the rates back up to 5.5 or so. And then what did they do in the housing bubble? They dropped it by 5% to 0. Now, when you have a 0% interest rate, that's a welcoming open for the banks to borrow for free and to misallocate capital with no risk. There's no interest on the, there's very extremely low risk. So where have we seen a lot of misallocation of capital in the US this time around? Mostly in private equity and in corporate debt. And so the corporations are borrowing at massive quantities and they're spending it on buying their own stock back. So what's the result? You get this extreme bubble. And so you don't have to be a genius to see they just have no room. There's, the best potential outcome from here that could extend that timeline and maybe give us another cycle would be something like you see right here, right before we had the worst inflation in history. Let me try to get that thing to pop down. Look at the 1960 period. They went to 0, they bounced back up, they went back down to 0, and then inflation got out of control. No matter how high they jacked that interest rate up, the second they pulled it back down, the inflation came roaring right back. And so they had to continue to raise these interest rates all the way to 20% to get all the misallocated capital, all the losing businesses, everything that was providing waste to the economy out. And so that's where we're at once again. And look at that period of time. You had 1, 2, 3, 4, 5, 6 recessions. And from 1965 through 1980, you had a 15-year bear market overall in stocks and bonds. Nobody is prepared for that. And what happens every time they do hike rates? You get your rare negative GDP print. And that's because our GDP is based on increasing debt. And so the problem right now is we're creating debt at a faster rate than we're creating GDP. We're creating higher and higher levels of interest, and that's creating a drag on our economy. So the big picture is quite worrisome, and there's not much they have left to do. They can drop the rates, probably 25, if everything goes smooth. If we really truly have this outcome, which I would have to say I believe has less than a 50% probability, and these problems continue, if China continues to slow, if our debt continues to grow at a pace that's greater than our GDP, if everything just kind of remains how it is right now, we don't have this miracle recovery globally and in the United States, if we don't become fiscally responsible with our deficit, the Fed has no choice. They have to slowly lower those rates to keep everybody from running for the exit in the bond market, and they have to start buying up more and more debt. And so they're buying up $60 billion a month right now, and that's slotted out to go into next year for about 6 months currently. And they're trying not to scare everybody, but every time we've had 75 basis points in cuts, we've had a recession shortly after. So will this time be different? We'll see. But if everything were hunky-dory, every 3 months they might cut the rate by 25 basis points, and you get to 0 within 2 years. So that's how I've kind of generated this timeline for us. Now, maybe they cut it to 0 and things look okay and they can raise it back to 1. But what we've seen is that the market's becoming hypersensitive to any inflationary shocks. And it's because of the growing amount of debt. So the system's much more responsive now to any pickup in inflation than ever before in history. And so we go back to 2008, look at that. A 3.8 print on inflation is what we hit right before that crash. And then go back to this period, 2000, we had a 3.4 print. We get a crash. And so in both those cases, they had a little room to cut. They could cut 5%. Every 1%, it changes based on the money supply, but there's some economists that at least calculated what the value of a 1% cut was in 2008. And at that time, a 1% cut was worth about $1 trillion of credit to the economy. But now the debt levels are about double. So I would assume that, and I think it's exponential. The closer you get to zero, the more credit each percentage point is worth in terms of credit impulse in the economy. But meanwhile, despite rates going lower, consumers' cost for credit is going up. So it's just it's a gigantic bubble, and you can see we're most likely 2 years to an inflection point where we hit zero. So that's really what we're trying to pay attention to is that's the big problem of the decade. This misallocation of debt relative to growth, and we're out of room to cut rates any further. So to summarize, if we don't have any panics in the market, I'd expect the stock market to continue to grow higher and the bond market to get upset and sell off. Once the bond market sells off, then it will cause the stock market to sell off. And then once we have inflation and the Fed says they have to hike rates, we get both the sell-off at the same time. Add panic to the picture, and we're going to expedite the timeline, but in reverse order. We're going to have stocks sell off first, spiking up yields on bonds. Then the bonds sell off as all the money flows out of the crash stocks. And then we end up in the same predicament where we're at 0% on the federal funds rate, and there's nothing else the Fed can do to manipulate the situation. And then here's what I'll leave you guys with this and see what questions you have. This is the alarming thing is, they're telling us 1.8 is our CPI print right now, but we saw the charts. They manipulate it and change the formula to suppress the reported inflation rate. And so we can see if we go back to the 1990 metric, we would be at almost 6% inflation, but at least it's steady. In this old measurement, at least it's a flat 6%. So that should push the federal funds rate right above it. So it should be around, and Jeffrey Gundlach's been talking about this for a while, the federal funds rate should be at 5.5. And the 200-year average for the cost of money has always been 5%. So we're way below that average right now. So the odds are that it will overshoot as we continue to pump too much money into the system versus how much productivity we're really getting. If you listen to Peter Thiel, we were supposed to get Star Trek, and instead we got Twitter, we got tweets, so innovation has probably slowed down. Instead of companies trying to innovate and compete, they're trying to monopolize their industry. They're trying to tack on a little extra feature. They're not really trying to make breakthroughs. And instead, they're trying to buy out all their competitors, put them out of business, and just continue to do what they know works. And so this slide is the alarming one. If you go back another decade and look at how they calculated CPI, it's not just at 10%, it's in a clear uptrend. And if this is the case, you go back to the Paul Volcker time and you spike that federal fund rate to something like 12 to 15% to get rid of all the misallocation in capital and to get prices to come back down. So they should already be rising rates, but they're not, because no political leader wants to create the medicine that we need right now. They want to try to delay it as long as possible. The catch is, the longer you delay it, the worse the problem becomes. But most people who teach you this kind of stuff, they tell you, yeah, you better load up 100% on gold and stay away from stocks. Now you can see clearly, I'm not telling you that. Understanding this, we're in a bubble, so we can make some nice gains if we play it safe, and we got to play it with put options below these assets because we're not at rock bottom prices. There's not blood in the streets. Everything's hunky-dory. We're in the top of a bubble. So that's why we're using very tight option collars so that whenever it does happen, we're extremely protected to the downside. Any questions out there, guys? We went for about an hour and a half. I appreciate everybody joining. Quite a crowd today. Let's see, Tom, I see your hands raised. Do you have a question? I think you got yourself muted right now. Oh, there you go.
I guess I didn't unmute it. No, that was from a long time ago. Thank you.
Yeah, my pleasure.
Jason, thank you. That was very enlightening.
Oh, my pleasure, Oscar. You got this whole scenario down pretty well now, huh? I think Oscar hasn't.
Yes, sir.
All right, gentlemen. Well, I really appreciate it. We'll get the replay out, and tomorrow we'll decide on which direction to play the TLT. I've been quite busy on listening to Jerome Powell's speech today. I still want to see what happened with the impeachment inquiry today, and then follow the news on China overnight, and try to get a hunch for whether we got a phase 1 trade deal or not. But I think it'll probably be time to go to this exact setup where we're extremely tight on equities and a little bit looser on the stock, on the bonds and the gold. Now that they've had this sell-off, I do think it potentially is bottoming out, and I do think maybe this phase 1 trade deal's either delayed or just not going to happen. So. All right. Thank you guys so much. Let me throw up my disclaimer here so no one sues me later. And we'll call it a day. So thank you guys very much. I really appreciate everyone's time and commitment to the program. And I hope you guys are enjoying the service.
Take care.
Okay. Until next week. Bye.